Imagine this. If you could double your money every 7 years, starting with just $10,000 at age 25, you'd be sitting on over $1.2 million by age 60, purely from growth. Yet, most people don't know the simple financial tool that reveals exactly how long this doubling takes for any investment. This lack of knowledge costs the average American hundreds of thousands in potential wealth, simply because they don't understand the speed at which their money, or their debt, truly grows. Today, we're unlocking that secret with a powerful concept called the Rule of 72. So, what exactly is the Rule of 72? It's a simple mathematical formula used to estimate the number of years required to double your money at a given annual rate of return. You simply divide 72 by the annual interest rate, and the result is the approximate number of years it takes for your initial investment to double. For instance, if you have an investment growing at 8% annually, it would take approximately 9 years, 72 divided by 8, for your money to double. This rule is a cornerstone of understanding compound interest without needing complex calculators. Let's put this into perspective with a common scenario: a savings account. Many high-yield savings accounts currently offer around a 4% annual percentage yield, APY. Using the Rule of 72, if you divide 72 by 4, you get 18. This means it would take approximately 18 years for your money to double in such an account. If you deposit $5,000 today, it would become $10,000 in nearly 2 decades, a testament to how slowly wealth grows with lower, albeit safer, returns. Now consider investing in a broad market index fund, like one tracking the S&P 500. Historically, the S&P 500 has averaged returns of about 10% per year over long periods, despite market fluctuations. Applying the Rule of 72 here, 72 divided by 10 equals 7.2. This means your money could double roughly every 7.2 years in such an investment. A $5,000 investment would become $10,000 in just over 7 years, a dramatic difference compared to the savings account, showcasing the power of higher returns. This striking difference highlights the true power of compound interest, the engine behind wealth creation. The Rule of 72 isn't just a trick, it's a quick way to visualize compounding. Each time your money doubles, the new, larger amount starts earning interest, which then doubles faster. For example, if you start with $10,000 at 10%, it hits $20,000 in 7.2 years. But then that $20,000 will become $40,000 in another 7.2 years, not the original $10,000, creating an accelerating snowball effect on your finances. One of the most profound lessons from the Rule of 72 is the immense advantage of starting early. Let's say you invest $10,000 at 10% annual return. If you start at age 25, your money doubles every 7.2 years. By 32.2, it's $20K. By 39.4, it's $40K. By 46.6, it's $80K. By 53.8, it's $160K. And by 61, it's $320K. If you waited just 7 years to start at age 32, you'd miss out on that entire first doubling, drastically reducing your final wealth. Time truly is your most valuable asset in investing. The Rule of 72 isn't just for growth. It also reveals the destructive power of inflation. If the average inflation rate is 3% annually, then 72 divided by 3 tells us your purchasing power is halved in 24 years. This means something that costs $100 today will effectively cost $200 in real terms in 24 years, if your money isn't growing at least as fast as inflation. It's crucial to invest your money in assets that outpace inflation. Otherwise, you're losing wealth even when your bank balance stays the same. On the flip side, the Rule of 72 has an evil twin when it comes to debt, especially high-interest credit card debt. If you carry a balance with an 18% APR, dividing 72 by 18 shows your debt doubles every 4 years. A $5,000 credit card balance could become $10,000 in just 4 years if you only make minimum payments that barely cover interest. This illustrates why high-interest debt is so detrimental to financial health, and why paying it off should be a top priority. You can even apply the Rule of 72 to real estate appreciation. While real estate returns vary widely, let's assume an average appreciation rate of 4% per year, excluding any rental income or tax benefits. Using the rule, 72 divided by 4 equals 18. This suggests that the value of your home could double in approximately 18 years. This is a helpful benchmark for homeowners to understand the long-term growth potential of their property as an asset and helps set realistic expectations. For future planning, like retirement, the Rule of 72 is an invaluable tool. If you aim to retire with $1 million and believe your investments will average an 8% return, you know your money will double every 9 years. If you currently have $250,000, you can estimate that it will become $500,000 in 9 years, and then $1 million in another 9 years. This means you'd need about 18 years for your current nest egg to reach your goal, helping you adjust your savings rate or retirement timeline accordingly. The Rule of 72 also applies to educational savings, such as a 529 college savings plan. If you're saving for a child's college education and expect a 7% average annual return from your diversified portfolio within the 529 plan, then 72 divided by 7 indicates your investment will double approximately every 10.3 years. Knowing this helps you project how much you need to contribute regularly to meet future tuition costs, which themselves are often subject to inflation, essentially doubling over time as well. When considering diversified portfolios, remember the Rule of 72 works with the average annual return. A portfolio that might include stocks, bonds, and real estate could aim for a blended return, perhaps 7% overall. This means your entire portfolio would double in just over 10 years, 72 divided by 7. This holistic view helps you gauge the overall trajectory of your wealth, rather than focusing on individual assets which might grow at different rates. It's important to understand that the Rule of 72 is an approximation, not an exact calculation. It works best for interest rates between 6% and 10%. For very low rates like 1% or 2%, it tends to overestimate the doubling time slightly. For very high rates like 20% or 25%, it might slightly underestimate it. However, for most common investment scenarios, typically within the single to low double-digit returns, it provides a remarkably accurate and useful estimate for quick mental math. Another crucial point is that investment returns are rarely fixed. The S&P 500, for example, averages 10% over decades, but year-to-year returns can fluctuate wildly, from minus 30% to plus 30%. The Rule of 72 gives you a benchmark based on an average rate, so don't expect your money to double precisely every X years without fail. Market volatility means some periods will be faster, others slower. It's a powerful long-term planning tool, not a precise short-term predictor. Beyond personal finance, the Rule of 72 has broader applications. For instance, you can use it to estimate how quickly a population will double if you know its annual growth rate. If a city's population is growing at 2% per year, it would double in 36 years, 72 divided by 2. This demonstrates the exponential power not just in money, but in any phenomenon that exhibits consistent growth. It truly is a versatile tool for understanding exponential change. So how can you act on this knowledge? First, focus on boosting your savings rate. The more money you contribute regularly, the more capital you have benefiting from the Rule of 72. Even an extra $50 or $100 per month can dramatically impact your future doubling cycles. Think of it as adding more snow to your snowball before it starts rolling downhill, giving it a much bigger base to grow from. Second, prioritize maximizing your returns responsibly. While savings accounts are safe, their 4% APY means your money doubles every 18 years. Moving even a portion of your long-term savings into diversified index funds, historically averaging 10%, could slash that doubling time to 7.2 years. That's 10.8 years saved per doubling cycle. Seek out investments that align with your risk tolerance, but offer substantially better growth potential than traditional savings. Third, conquer high-interest debt aggressively. Knowing that your 18% credit card debt doubles every 4 years should be a huge motivator. Prioritize paying off any debt above, say, 7–8% interest. Think of every dollar you pay towards high-interest debt as an immediate, guaranteed return equal to that interest rate. It's like finding an investment that doubles your money from loss to neutral faster than almost anything else. Fourth, regularly review your financial strategy. Your income, expenses, and investment goals will change over time. What worked 5 years ago might not be optimal today. Reevaluate your expected returns, your contributions, and your debt levels using the Rule of 72. Adjust your allocations or savings targets to ensure you're on track for your doubling goals, whether that's for retirement, a down payment, or early financial independence. The Rule of 72 is more than just a formula. It's a mindset. It's about understanding the exponential nature of money, both for growth and for debt. By internalizing this simple rule, you gain a powerful lens through which to view every financial decision. Whether you're optimizing your investments, crushing debt, or planning for retirement, the Rule of 72 empowers you to make smarter, faster choices that will significantly accelerate your journey to financial freedom. Start applying it today,